Good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, Certified Financial Planner Kevin Zivna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls. If you have a question or comment relating to your own personal financial situation or anything I'm talking about here tonight, jump on the phone lines, give me a call, 627-7979. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get you right on air. 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interests ahead of our own in any business dealing or recommendation that we make, and that's the way it should be when you work with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday at 6 p.m., and that's to reach out and help as many people in the Hampton Roads listening area that we can achieve your measure of financial success, because it is a core belief at Wealthway that the overwhelming majority of people in this country have the opportunity for financial security if they choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone, give me a call, 627-7979, whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies, retirement planning, retirement plans, 401ks, 403bs, TSPs, IRAs, Roth IRAs, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts. All that and more falls under the umbrella of personal finance. We are here to discuss tonight. 627-7979. All right, tonight we are going to talk about the hidden cost of waiting. Financial decisions that get more expensive over time. So one of the probably most expensive words in financial planning is the word later. And most financial mistakes are not really caused by bad decisions. Most financial mistakes are caused by delayed decisions. Because, most people know kind of what we should be doing from a financial standpoint to give ourselves an opportunity at financial security and financial success. But we often postpone taking action because life gets busy, the decision feels too big or overwhelming, or people just get complacent and they assume they have more time than they actually do. And it's very common in financial planning, financial advising, where most people just postpone. They just delay because it's always easier to put off some major financial initiative till another day instead of today. And then the days turn into weeks, the weeks turn into months, the months turns into years, the years into decades, and next thing you know, retirement's knocking on your door. So procrastination, one of the things we have to guard against when it comes to financial success. But time can be one of your greatest assets when you're trying to build financial security. So tonight we'll explore how waiting affects retirement savings, tax planning, estate planning, might get into some healthcare planning, and general overall retirement readiness. And so the main message is that action is often more valuable than perfection. Doing something, even though it is less than ideal, is better than doing nothing. So we're going to talk about that. So first off, waiting, let's talk about why waiting feels safe, but oftentimes it's not. Because as humans, we're pretty much wired to prioritize immediate comfort over future benefits, right? Much rather buy the fancy car, take the lavish vacation, buy the new shoes, get the nice wardrobe. All that gives us instant gratification. It feeds our consumerism need. And spending below our means, denying ourselves those pleasures, or at least delaying them, that's not as fun, right? It doesn't feel as great to contribute, say, $500 a month to your 401k plan as it does to take that $500 a month and do something fun with it. But we also know for long-term financial success, it's the right thing to do. So even though it's the right thing, it's the hard thing to do. And the result is that many people delay important decisions even when they know those decisions are important. Behavioral financial research consistently identifies procrastination as one of, if not the biggest obstacles to long-term financial success. And if you're noticing a theme here between this show and probably about the last 2 or 3 that I've had, or you podcast listeners, most of the message has to do not with technical aspects of financial planning or financial advice. It has to do with your own particular behavior, something that is entirely within your control. It's not the markets. It's not the right credit card to get. It's not about trying to find the right savings account with the highest interest rate, or whether you choose between a Roth or traditional IRA. No, these are all behavioral issues that you have the power to overcome. If you have a job, you have income, you have opportunity for financial security, and then one day, if you're so inclined, financial independence, where you rely on no one else and no labor to live off your funds in a very comfortable lifestyle. So that's what tonight is about, the hidden cost of waiting. A little bit more supporting facts here. A recent study by Northwestern Mutual did a planning and progress study. Many Americans report knowing they need to improve their financial planning, but have not yet taken action, right? So it's something we know we need to do, but we delay it. So a lot of times we hear from clients or callers, I'm waiting for the perfect time. When everything else in my life is settled, then I'll take up this financial planning project. Well, there never is a perfect time in life. A lot of times we'll hear, I'm not even close to retirement yet, so I don't have to worry about this. I'll wait till I get into my 50s, 60s, then I'll worry about it. No, then you squander all that valuable time by waiting until you're too close to a pivotal period of time in your life. Another one we hear, waiting for markets to become less volatile. No, volatility is a hallmark of investment markets. It's something that we have to. It's a condition that we have to accept as the price that we need to pay in order to enjoy higher long-run rates of return than we can get from banks or CDs, savings accounts, money market accounts, or annuities. All these other products have much lower rates of return than the long-term growth prospects of the investment markets if done properly. So you want to harness the good parts of the market, and that just means accepting occasional temporary market decline. So the market is volatile. That's the price of doing business. Here's another one. Waiting until income is higher. I'm not making enough money now. I'm stretched too thin. I need to get a new car. I need to save up for my first house. The kids are starting to go to school. They're going to need clothes, and the list is endless, right? Waiting until income is higher, yeah, hopefully that does happen over time as you grow in your career. But as your income grows, so do the demands on that income. So there's never a perfect time to really get engaged in your own financial health. Now is that time. That is the only time that is the best time. Now. And, it's some ways that it manifests itself is, we will kind of hear from people in their 50s, like a 55-year-old couple knows they need a retirement plan, but they delay that because retirement still feels like, well, it's this conceptual thing. It's this theoretical thing that I'm not ready for yet. But when I get to my 60s, that's the retirement zone. Then I'm going to buckle down and get seriously. But when retirement becomes real, but then many planning opportunities are compressed into a short amount of time, and they don't work as effectively as when you start them earlier. So waiting is like standing on that one of those moving walkways at the airport. You're stationary on the walkway, but the walkway is still moving you forward. We're all on that treadmill, right? We just got on at different points. Time is the same for all of us. It moves at the same speed for all of us. What we decide to do with our time is what differentiates ourselves. We'll get into more of the hidden cost of waiting after we come back from these messages. If you want to jump on the phone lines, give me a call, 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can check us out online at wealthwayadvisors.com. All right, tonight we're talking about the hidden cost of waiting, financial decisions that get more expensive over time. So the cost of waiting to save and invest. Yeah, this is probably one of the biggest. So time is one of the few assets that cannot be replaced, right? We all have the same amount, and once it's gone, it's gone. Lost years of compounding are permanent, but most of us face a tricky paradox, right? When we're young, we have comparatively a lot of time, but we don't make much money. Entry-level jobs don't pay a whole lot because generally you're being paid to be trained. You're not that valuable to your employer yet, but hopefully you're on your way. So entry-level jobs don't make a whole lot of money, even though you have a lot of time out in front of you. And then when you're near the end of your career and looking at retirement, you're probably making the highest income of your career at that point in time, but you now have less time ahead of you. So if you want financial security, you have to overcome that paradox. At some point along the continuum of your career and your life, you need to live less for today and plan for the future. So some facts that sort of back this up from Vanguard. We have consistent long-term saving remains one of the strongest predictors of retirement readiness, not chasing market returns. Yes, it's the consistency of the long-term savings. It's the habit. It's not a magic investment that's going to make you financially secure. Federal Reserve had a survey come out a couple years ago. Retirement accounts remain one of the largest sources of wealth accumulation for middle-income households. No surprise there, except you have to take advantage of those retirement accounts through your employer. If you don't, that's on you. Nowadays, things are getting a little bit more automated. Some employers are defaulting to enroll you in the plan and not only force a contribution from your paycheck, but also get it invested in something sort of comparable to what it should be invested in. More of that is happening automatically through your employer, and you have to opt out. In the past, you would have to opt in to the plan and know which investment to select. Now, some employers are defaulting to enrolling you and getting you invested, and you have to say no if that's something you don't want. So it's overcoming our own human nature to resist that living below our means and saving for the future. Some of the misconceptions that we hear for people why they delay waiting to save and invest. Well, I said this earlier, I don't make much money. I'll save more later. When I make more, then it will have more impact. No, not necessarily. It doesn't take a lot of money to one day have a lot of money if you have enough time. You just have to get started. Another thing we hear, well, I need a large amount of money to get started. I need to start with a big lump sum, so I'll just save it up in my checking account until I get to critical mass, and then I'll move it over to an investment account or IRA, for my retirement down the road. Life has a way of conspiring against that behavior, and oftentimes there's always something that comes up every month that is unexpected that prevents you from ever actually building up that large amount if that money is in a checking account or bank savings account, just too close to your fingertips and too easy to spend. Needs to be in a retirement account with some handcuffs around that in the form of penalties or taxes that if you try to take it out, it makes it more painful. And then another misconception, well, I'm going to wait till I'm later in life in my 50s because that's when I'll be making more money. The kids will be out of the house. They'll be graduated from college, and I'll have just more disposable income, and then I'll really start plowing it away. All right, that is sort of an overall truism for most people. That's kind of the trajectory of career and life. But again, waiting too long just means you're going to have to save even more money to be able to maintain your lifestyle throughout retirement. Better to start earlier with small amounts. It's less painful at that point in time. And one of the things that we sometimes either see in real life or ways that this manifests itself is that many households assume that future raises will solve current savings challenges, but oftentimes, for most Americans, spending often rises with income. The more we make, the more we spend, right? Because that's what we're working for, right? Have a good quality of life and be able to enjoy the fruits of our labor. Yes, you can. You absolutely can do that. Most Americans do. There's probably only about 20%, my rough unscientific estimate, only about 20 to 25% of the population that really is actively trying to build long-term financial security. So consistency matters more than perfection. You don't have to worry about necessarily the right mutual fund, the right ETF, even the right type of IRA, Roth, traditional, non-deductible. All those technicalities take a back seat to starting to put meaningful money away that you will not touch until a much future date, where you can help yourself overcome our human tendencies to want to spend rather than save, is automate your saving and investing. Set up an automatic, and the easiest place for almost the majority of us to do that is to your employer. Contribute to your company-sponsored retirement plan. They will deduct the money from your paycheck before it even gets into your hot little hands in the bank account with the direct deposit. So do that first. Use your behavior to your advantage. Don't let it get into the bank account. Save first, spend second. You will be much more successful about building meaningful long-term wealth. And then, if necessary, catch up contributions in IRAs and 401ks. Once you reach age 50, you can even increase the amount once you hit those later years, just so you have more opportunity to do that. All right, going to take a short break right here for the news. Be back in a couple minutes. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes there, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for. It's just to send you the information that you request. Or if you have some nuanced questions, want to speak to a live human being, give us a call at the office, 456-2200. Want to remind everybody, our next live show will be in 3 weeks, just due to the way the calendar falls. 3 weeks on the second Tuesday of July. That'll be July 14th. But if you can't catch us live every second and fourth Tuesday of the month, get this show as a podcast. Search for Dollars and Common Sense wherever you get your podcasts. Download us, take us with you where you go, and listen at your convenience. And for those of you into social media, we have a presence on Facebook and LinkedIn. Search for Wealthway Financial Advisors, hit that like or follow button, and once every week or so, we put up an interesting and informative financial planning post to keep you engaged in the process. All right, tonight we're talking about the hidden cost of waiting, financial decisions that get more expensive over time. And just to finish up the last segment there, why people often wait to save and invest, one of the things that they miss out on, one of the most valuable things that they miss out on by delaying are the effects of compounding interest, compounding dividends, money that is paid on your money that then grows with your money. Compounding is like planting an oak tree, and the best growth happens because of time, not because of effort at the very end of the growth of the tree. It's the steady consistency of the addition to the company retirement plan or to an IRA or to a mutual fund. The consistency over time and the effects of compounding of your money earning money year after year. That's the most valuable part and what you miss out on by delaying saving and investing. All right, another area where people often delay or try to avoid is the cost of waiting on tax planning, right? Tax preparation happens after the year ends, but tax planning happens throughout the year. And in fact, we at Wealthway say that tax planning is really a lifelong plan. And when we do tax planning for our clients, we aren't just trying to save them money in one particular year, although if we can, we will. But we're looking to minimize their entire lifetime tax liability, because sometimes some strategies, some tactics take several years to play out in order to get the full benefits for them. So, some of the misconceptions that we hear around tax time, why people delay. Well, my CPA will take care of that at tax time. No, there's almost nothing you can do after the books close on December 31st. There's a few things, but they're limited. After the books close on December 31st till April 15th, there's not a whole lot you can do there from a tax planning standpoint. Another thing, people think tax planning and tax filing are the same thing. No, tax planning is how you structure your financial affairs to pay the least amount of tax that you are legally liable to pay. Tax filing is filling out the paperwork to send to the IRS to tell them how much tax you need to pay. Tax planning and tax filing, two distinct operations. And so what we see in real life is that sometimes people show up in February wanting to reduce their taxes from the previous year. Many opportunities disappeared from the weeks earlier. Tax planning is year-round, and the goal should be to lower your lifetime tax bill. And there are several big strategies that we employ at Wealthway that can help people do just that. Sometimes retirees will miss a Roth conversion opportunity during a low-income year. That's one of the things that we used to like, strategic Roth conversions, if you have the profile to make it beneficial. So you're going through a low-income year between the time you retire and then maybe Social Security kicks in, might be a good window for Roth conversions. That can save you a ton of money over the rest of your life. Investor realizes large capital gain without planning for tax consequences. That's right, indiscriminate selling of your profitable investments. If you sell the ones with the most profit, you are then going to pay the largest capital gains tax on that profit. And sometimes when you get into the weeds, and you can selectively sell specific trade lots in your mutual fund or ETF or even stock holding, then you can create the same amount of cash that you need to spend, but do so with a lower capital gain and therefore pay lower taxes. But you have to be very meticulous in your record keeping and know which tax lots to sell. Another thing that can often throw people for a loop when it comes to tax planning, a business owner who waits until March to discuss previous year-end tax strategies. If you own a business, you have more tax. Well, you're probably paying more tax, but you also have more tax-saving opportunities if you are able to structure your revenue and expenses in certain ways. But you've got to do that early in the tax year to take advantage of it for that tax year. You can't wait till after December 31st and before April 15th to make a whole lot of hay there. The door is closed on many opportunities when you wait that long. So Roth conversions are big tax saving strategies, but you have to, we've done the math enough times. We know certain conditions must be present in order for them to work and to be meaningfully beneficial. But when they do work, man, we have literally saved clients hundreds of thousands of dollars and sometimes millions of dollars of tax savings over a lifetime if the numbers are big enough and we have enough time. That's how powerful it can be if you have the right situation. Charitable giving strategies, something that should not just happen at the end of the year. There's more meaningful ways to give. Donor advised funds, charitable remainder trusts. People who are significantly charitably inclined can go a long way of reducing their tax bill if you thoughtfully plan your charitable giving. Capital gain management, I just kind of talked about that. Income timing, if you have the ability to structure your income, a lot of times salespeople have some flexibility over that. Business owners have some control over that typically. Timing of your income can help reduce your taxes. And then retirement account contributions, if you are eligible for contributions to a traditional IRA, which is deductible to a certain extent if your income is below a certain threshold, or making Roth contributions. While you don't get a deduction on the way into a Roth, you get tax-free income on the way out of the Roth. But you have to take advantage of them as early as you are able. You cannot just wait. There are income limitations. The maximum contribution right now for Roth or IRA contributions in 2026 is $7,500. So not a really huge number. Unless you're age 50 or older this year, then you can contribute another $1,100 for a total of $8,600 there to traditional and Roth IRAs. But again, not a huge number, not going to move the needle much later in life. Can absolutely be an excellent financial foundation if you're in your 20s and 30s and making maximum contributions every year. But you got to start. If you don't start, you're not going to have the success. So tax planning is like preparing for a snowstorm, right? Once the storm arrives, most preparation opportunities are gone. You have to be prepared before the storm. All right. We'll take another break here. We'll be back in just a minute. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can check us out online at wealthwayadvisors.com. All right, tonight we're talking about the high cost of waiting. But before we get into our final segment, we got a caller on the line, Donnie in Virginia Beach. Good evening, Donnie. You're on Dollars and Common Sense. And do we have Donnie?
Yeah, we should have Donnie.
Donnie, we're looking for you.
All right, we'll have to come back to Donnie.
All right. Well, we might have lost you there, Donnie. If you're listening, then give us a call back. See if we can help you out. Okay. So the cost of waiting on estate planning. So this is a common one as well. Estate planning often delayed because people associate it, of course, with dying. But in reality, estate planning is about protecting people while you are alive and after you are gone. Survey from caring.com, majority of American adults still do not have a will. Estate planning attorneys routinely identify incapacity planning as one of the biggest planning gaps, and I would probably agree with that. We associate estate planning with death, but really a significant part of estate planning is what to do about certain situations when we're alive. If you become incapacitated is one of those situations. If you are unable to make those decisions for yourself because of incapacity, what would you like? How would you like to be treated in the healthcare system? What type of treatment would you like? How long would you like to be kept alive under certain circumstances? Who do you want to make those decisions for you? Who do you want to make your financial decisions for you? All those can happen while you are alive and have nothing to do with death. And so that's an important part of estate planning, yet we put the whole thing off because we don't want to deal with the uncomfortable subject, which I understand. All right, we got Donnie back on the line, I think, and we're going to try again. Donnie in Virginia Beach, good evening. You're on Dollars and Common Sense.
Can you hear me now?
Yes, we can.
Okay. I'm at a point now where I've been listening to these radio stations, and they've been promoting, gold and silver buys rather than the currency. So I'm kind of like interested in that. Now, of course, they talk about either buying gold or silver bars. They talk about buying gold or silver proof coins with certificates and authenticity, or buying uncirculated in a tube, like they'll buy maybe 25 or 50 in the tube. And I'm trying to decide whether to go with A, B, or C. What would be your advice on something like that? And this, of course, would be, part of moving some of my net worth into those precious metals, and of course would be transferring it, what inheritance to my family.
Okay, so is the question which type of precious metal to buy?
Yeah, whether to buy the bars or whether to buy the proof coins, like the gold eagles or the Canadian eagles and silver and gold, or buy the uncirculated coins. They call them uncirculated, and you get like a tube of them in a tube with like 25 or the quantity you buy. But I kind of lean towards I don't want to. I'm trying to stay away from the bars, which are probably 999% gold or silver. I think the better thing would be the proof coins. They're in the case and they're enclosed, and they come with a certificate and all these authenticity statements on them, or the uncirculated, and they say they come in like in a tube of maybe 25, and they claim they're uncirculated.
And Donnie, what is it about precious metals investing that interests you?
Well, it's maybe, most of my investments now are in stocks and certificates and IRAs and a few other things. But I just thought maybe, since they're talking about what silver is going to go up to and how high gold has gone up to, and the banks are only giving like 3%, and they feel that silver is going to be very increasing in price. So I'm kind of looking at that. I'm just thinking about this. I haven't made my decision because I'm very cautious, but I'm just looking, trying to dot all the I's and cross all the T's. And then when I'm ready to decide to do that, if it's either yes or no, I'll know which way to go. And I'm kind of leaning towards the proof coins because I thought they would be better saleable if I want to convert them or sell them someday.
Okay, well, we don't have a really high opinion of investing in precious metals as a long-term wealth-building activity. Generally speaking, I don't personally know too much about how silver has performed over time, but I do know gold, and gold barely keeps pace with inflation over a long period of time. Yes, there are pockets here and there, 6 months or a year, when it will have a run-up. But you look back over the last 10, 20 years, gold has not even kept up. The price of gold has not even kept up with inflation. So that means you're actually losing purchasing power with gold over that extended period of time. And then you have the complexity of where do you store it? Where do you keep it? You have to safe deposit box. You're safe in your house. Put it under your bed. The risk of that. And then when you go to sell it, there are different tax rates, capital gains rates. When you sell it at a profit, there are higher capital gains rates that apply to precious metals and antiques, and there's another one I'm forgetting. But some of those irregular type of investments, you pay a higher tax rate on the profit on those than you do on conventional investments like stocks, bonds, mutual funds, that type of thing. So the growth prospects in precious metals don't stand up long term from an investment standpoint. So I guess my opinion on that would be a pass on precious metals, unless you had some really specific reasoning for wanting to do that.
Hmm. So, taking your advice, pass on the procurement of gold and silver, and stay in with the certificates and the IRAs.
Well, that's a good place to save. Bank savings account, money market account, CDs. That's saved. That will get you about in the current interest rate environment 3 to 4%, which is not great, but is kind of keeps pace with inflation. So that's where your savings go. But your investments, the best long-term investment vehicles is common stocks. Those are the ones that have returned over time in mass, in general. There are definitely exceptions, but 8, 9, 10, 11% on average each year over time, and that's a meaningful return number.
Yeah, I go along with that. But, with the situation over with Lebanon and Iran, every day I listen to the market, and it goes up 500, it goes down 600, it goes up 300, it goes down 150, and you got to look at the long run. I go along with you. You got to forget about the short run.
Exactly.
But you're right. I have some stocks. I have a good stock that was a couple years ago was in the 400s, and now it's in the 700s. So I believe in that, in the stock market, the long run would be the risk. But, I'm a senior citizen, and I have to diversify, and I don't want to go, too high in the risk factors of the stock market or the gold. And, of course, I look at your comment that, with the 3 and 4% in certificates, and my key factor is preservation of principal.
Mm-hmm.
And when I maintain the certificates and the IRAs and the reputable financial institutions, I'm obtaining preservation of principal.
Right, exactly right. And that's where you want to keep your safe money at your fingertips. You're not looking for growth out of that money. You're looking for protection. That's your comfort blanket at night when you put your head on the pillow. That's the good place for that type of money. All right, we got to wrap things up tonight. We talk about the high cost of delaying our decisions. The goal is not to make every financial decision today, right? The goal is to identify the decisions that matter most now and then begin moving forward. Take some action. This is opportunity knocking, but you have to open up the door. That's all the time we have for today. We'll be back in 3 weeks on Tuesday, July 14th. I'm certified financial planner Kevin Zivna. You've been listening to Dollars and Common Sense on News Talk 790 WNIS.